Hello there, this is Ross Maynard here, and today I'm presenting the Lean Accounting Challenge. So I'm presenting this overview of lean accounting concepts in conjunction with BMA, who are the lean accounting leaders, the leading lean accounting consultancy in the world. And you can find much more information at their website, maskell.com, and also at the Lean Accounting Supergroup. The address there at the bottom of the screen. So I have worked with Brian Maskell and his colleagues for very nearly 10 years on lean accounting projects, and I'm presenting this in conjunction with them to outline the key concepts in lean accounting. So the first thing to say about lean accounting is that it's about applying lean thinking to accounting processes. So it's aligning our finance function, our accounting processes and activities with the lean philosophy. So we want performance measures that motivate lean. We need to be able to streamline accounting processes and transactions to take out the waste. We need to report by value stream, and we'll come back to that shortly. So rather than by function, we report by value stream. We need to be able to support the lean decision making, so the lean philosophy in planning and decision making. And we also need to focus on customer value at all times. So let's start with the definition of lean. And this is by Taiichi Ohno, who is one of the creators of the Toyota production system. And he said, all we're doing is looking at the timeline from the moment the customer gives us an order to the point when we collect the cash. And we're reducing the timeline by reducing the non-value added wastes. So this makes it clear that lean is about the flow of work through a business process, and it's about reducing the time that that business process takes by reducing the impediments to that flow, which in lean terminology is called waste. So lean is all about streamlining the process by taking out activities which the customer does not value and by improving the efficiency of the activities that remain. And lean accounting aims to support that philosophy by providing decision-making information, by providing performance metrics which support that challenge of reducing the timeline, and also by streamlining finance processes. So why should we look at lean accounting? Well, many organizations use traditional standard costing, absorption costing it's also called, and this was developed for mass production from the 1920s onwards. And the concept behind standard costing is that profitability is maximized when labor and machine utilization are maximized. So this is why in traditional accounting systems we have metrics for labor utilization, machine utilization, variances, the absorption of overhead, etc. And the aim in the traditional standard costing is that the lowest cost per item is achieved through economies of scale. Now, the problem in the modern environment is that we have multi-products, we have a very competitive marketplace, we can no longer sell all that we want to produce, so we have a much more complex environment. And this philosophy behind standard costing does not apply in a high variability multi-product environment, in a modern environment. In a modern environment, profitability is maximized when the rate of flow through the process is maximized. So this is a completely different viewpoint. Instead of looking at labor and machine utilization and trying to maximize those based on the concept that we can sell everything we produce, lean accounting looks at the process, the timeline of the process, the flow of work through the process, and aims to optimize that flow of work, because that is when cost is reduced and therefore profit maximized. So we can look at that in a bit more detail. And lean accounting really says that there is no such thing as standard cost. As we move towards a lean environment, the cost of product is related to the flow through the business processes. So waste which is those impediments to flow I mentioned earlier. They affect the flow through the process, and this means that there's no one single standard cost of a product. The cost of a product actually varies from day to day to week, depending on the level of output that you have, depending on your first pass quality yield, depending on the amount of scrap created, the product mix, downtime, and so on. There is no such thing as one standard cost. So lean accounting says, let's forget about this false idea that there is a standard cost, and let's instead look at the flow through the value stream. Let's cost the flow through the value stream, and let's aim to improve that flow, because by improving the flow, we create capacity, and that gives us the flexibility to do more profitable work. And if we can do more profitable work, then of course our profit is increased, because we know that the cost of the value stream is set. So this is moving into the concept of lean accounting. Lean accounting is all about flow through the process. So if we manage the flow, i.e. if we stabilize the process, then we manage the cost. We know the cost of the people required for the process, the cost of the equipment, we know the cost of running the process, we have a stable process, therefore we understand cost. If we can improve the flow through the process, i.e. complete the timeline of the process more quickly, then we create capacity in the process. So if work previously took, let's say, 5 days for a piece of work to flow through the process, and we can reduce that to 3 days, then effectively we've created 2 days of spare capacity, which we can then go and sell for other work without any increase in the cost of the process. So by increasing the capacity of the process, we increase its potential for profitability, because we can sell that extra time that we've created to new markets, to new customers, for new products, etc. And therefore, the profitability of the organization and of the process is related to the rate of flow through the value stream being the lean word, if you like, for the process. So let's have a quick look at what's wrong with absorption costing, full absorption standard costing. Well, firstly, it distorts profitability by having an inappropriate overhead application. The standard cost is worked out typically at the beginning of the financial year, based perhaps on the previous year's output. We have no indication that this year's output is going to be the same. Product specifications may vary, product mix may vary through the year. It's really, we're starting from a false assumption, essentially. Standard costing also motivates non-lean behaviors. If we're looking at machine utilization or labor utilization, then we're going to keep those machines and those people working, whether or not there's customer demand for our products. And this tends to lead to the building up of inventory and stock, which of course disrupt cash flow and lead to problems of obsolescence, etc. So it motivates these non-lean behaviors. And in a lean organization, we want to be able to motivate positive lean behaviors. Also, few people outside of the finance team actually understand standard costing. Variances are very complicated. I had to study them for years doing my accountancy qualification. They're very hard to get to grips with for non-experts. And also, finally, and perhaps most importantly, standard costing counts labor as a variable cost. Actually, in the modern world, for practical purposes, labor is largely a fixed cost. We have salaried staff nowadays. Okay, we may have some temporary staff to fill peaks and troughs in demand, but essentially our labor cost, our staff cost, is fixed. So let's move on then to the 7 aims of lean accounting. Lean accounting, as I say, is designed to support the lean philosophy, support the concept of the business process, the value stream, and improving the efficiency of the whole process by taking out the waste, taking out the impediments to flow, and therefore freeing up capacity in the process. So lean accounting, the first aim is that it will create performance measures that motivate lean behaviors, and these will be cell level measures and value stream level measures, and we'll take a look at those shortly. Secondly, that we will have value stream costing to replace standard costing. So each value stream in your business, which would be the principal revenue generating processes, will have their own value stream profit and loss account, where the direct costs and the attributable costs of running that process are aligned to the revenues to show that the contribution that each value stream gives to overheads and to corporate costs. Thirdly, we want to be able to support relevant, accurate, and timely decision making, and we use a contribution costing type approach to this. So we ignore standard costs because of this problem with overheads, and we look at what is the actual additional cash flow of the decision providing. Fourthly, applying the lean philosophy to accounting transactions, accounting processes, we aim to eliminate unnecessary accounting transactions, minimizing stock transfers and works orders and all these sorts of things, because there are other methods that we can use in lean that provide a better outcome. Fifthly, we want to be able to highlight the impact of lean improvement, how effectively our improvement activities have eliminated waste, have improved capacity, have improved flow, and ultimately have improved cash flow and profit. Sixthly, we want to help drive the growth of the business by focusing on the customer value, and this uses an approach called target costing, for example, but essentially we're all focused on how much additional value in terms of cash have we derived from our efforts at improvement, and lean accounting is focused on that. And finally, we want to motivate lean behaviors in the planning process using sales, operations, and financial planning techniques. So again, a contribution type costing focus for the planning. Okay, so this is the key tool of lean accounting, and it is called the box score. And you can see here that this is essentially a weekly performance report, which comprises operational measures at the top in yellow there. It measures the capacity of the value stream in the middle there in blue, and it looks at the financial impacts of those improvements at the bottom there. And we can see here a sort of 5-week progress here of we've made some improvement activities. As you can see, in terms of the capacity row, we started with 58% non-productive capacity. In the final 2 weeks, we've managed to sell some additional work into the process, and that's created increased profitability there. So we have removed some waste, and we've made that available in order that we can go into the future and sell it. So the top of the box score comprises measures of lean performance, as I mentioned, and these are measures which motivate lean behavior. The middle shows how we use the capacity in the value stream. Productive capacity is the time spent, the proportion of time spent doing value-adding work. Non-productive is the proportion of time lost to waste, such as downtime, scrap, etc. And available is the spare capacity that we have available to sell for new work. And as we can see, that's increasing in this example, so that we can go out and sell to new customers, new products, etc. And thirdly, the financial measures link the performance of the value stream to the flow or through the value stream. And notice here we do not have overheads in this cost table. We have the direct revenue of the value stream, and we have the direct and attributable costs of the value stream, showing a value stream profit. We do not allocate or apportion overheads to value streams in lean accounting. So the aim of lean improvement is to reduce waste and create available capacity, as we can see is being done here. And we make increased money when we sell that available capacity. So in this example, profitability hasn't increased. In fact, it's rather dropped because we haven't yet gone out and sold that 38% available capacity. So we need to find new markets. We need to plan for new products, new customers, in order to increase the profitability of our value stream. Units per person is a measure of productivity in the value stream, and we can see in this example it has increased by about 10%. On-time shipment is of course a measure of our ability to meet customer demand. First time through is a measure of quality, so it's the first pass yield is another name for it. And essentially, what is our first time quality through the entire process? And you can see here, even at 54%, that's pretty poor performance, and that will lead to a lot of rework, which is probably reflected in the non-productive capacity row there in the middle. Doc to doc days is the flow time, so the time from initiation of the order to delivery to the customer. And we can see in this example, we've made a fairly dramatic improvement in the flow time, which has helped create additional capacity there, which we now need to go out and sell, as I mentioned. And here is a measure of cash flow, accounts payable to accounts receivable days, fairly static in this example. Here we have a target profitability of 46% and a target profit of around 40 to 50% is pretty standard for value streams because we have not apportioned any corporate overheads to the value streams, and therefore we need to still cover those overheads. Productive capacity is the time spent adding value, doing profitable work. Non-productive capacity is the time lost to non-value added activities, as I mentioned, waste, rework, scrap, downtime, etc. And available capacity is the time that's available to do new profitable work. So as lean improvement releases capacity, we need to go out and sell that space in our process in order that we can reap the benefits of increased profitability. At a value stream level, typically on a monthly basis, we have the value stream profit and loss accounts. So in this example here, we can see we have 3 revenue generating value streams: motors, systems and spare parts, and also 1 non-revenue generating value stream, which is new product development. And we can see at a summary level the sales and the direct costs of the value streams, giving us value stream profits between 31% and 47% here. In the column that's labeled support costs, that's where we put those overheads, which I said were not apportioned to value streams because they are not driven by value streams. The costs in the value streams are those costs which are directly driven by running and operating the value stream. All other corporate overheads are not allocated or apportioned and are kept there in the support cost column. So they are a cost, and that of course adds up to the total division there. There's adjustments for inventory at the bottom there, so inventory change leading to corporate overhead. And those top line figures will align with what traditional accounts show. It's just the means of getting there is different, and we're showing a process-based, a value stream-based approach to revenues and costs, so that we can show how effective each value stream is at the top level. So we have operating costs for the revenue generating value streams. We have a non-revenue generating stream, as I mentioned. We have the corporate overheads, which are not controlled or driven by the value stream teams. And we have different levels of profitability in different markets, which is entirely usual, entirely normal. And finally, we have some financial adjustments to bring us back to the traditional measure of net profit. It's important to say at this point that lean accounting is not just about measures. It's not just about changing the structure of our management accounts. It's also a people process. We aim to drive the lean behaviors. We aim to encourage the culture of improvement. So lean is a production system that highlights problems, which is coupled with a human system that creates people who are willing and able to identify and resolve those problems. And actually, our processes can only be improved by people working together using problem-solving methods to eliminate the waste in the process. Improvement is a people-driven process activity, and involving people in lean there is at least as important, more important in my view, than any lean tools that you may have heard about. Getting the people engaged and truly working on improvement is far more important than having a checklist of lean tools. So Lean is a collaborative set of behaviors which results in a culture of continuous improvement. And these behaviors focus on improvement, they focus on problem solving, they focus on the process team working together to improve the efficiency of their process. And managers in all of this are teachers, facilitators, and mentors. So they support improvement, they provide air cover where it's needed, and they help provide training and facilitation for improvement. So what are the benefits of moving away from the sort of traditional approach to accounting to lean accounting? Well, it helps us to show the financial benefits of lean, which is completely impossible in a standard costing environment. It gives us a better way to understand product costs, because this concept of standard costs, as I showed, there is no such thing as a single standard cost. The new performance measures focus on flow through the process, focus on quality, focus on delivery, and therefore support the lean journey. Lean accounting also helps us to understand and stabilize the value stream and control its costs. And applying the lean philosophy to the accounting function helps us to create a low waste accounting control and measurement system. It also helps us to focus on new ways of making management decisions, such as pricing decisions, make-buy decisions, product rationalization, and so on. And finally, lean accounting focuses the business on the value that we create for customers and the capacity that we create by removing waste, which we then need to go out and sell to increase profitability. So let us look in summary at the heart of lean accounting. Well, clearly we need executive sponsorship to be able to move ahead and change our accounting processes to focus on the lean philosophy. We need to define our value streams, and your definition of value streams may change over time as you get more sophisticated, as you get better at improvement. So we need to be flexible in our accounting system so that we can change the definitions of where costs and revenues go as we get better at value streams. We need to agree the performance measures which will support the lean philosophy, and typically this will be perhaps no more than half a dozen performance measures for a value stream. We need to be able to identify those direct value stream costs and revenues, the revenue generated by customer value, direct material costs and people costs of the people working in the value stream, machine costs, space and energy costs, but without allocation or apportionment of overheads. We need to be able to measure capacity in the process, and this is a fairly technical task which takes some time to get to grips with. We need to develop the box score that we saw earlier in the presentation, which is a combination of lean measures, combination of capacity, and the combination of the financial impacts of those measures. And at the corporate level, at the management level, we bring those together in the value stream profit and loss accounts so that we can look at the contribution that each value stream makes to corporate overheads and corporate profit. So let me finish with some books on lean accounting. The key text there is Practical Lean Accounting by Brian Maskell and Bruce Bagley. And they and their colleagues have also written the Lean Business Management System there, both of which are available from maskell.com and also from Amazon. And there's also a number of other books on lean accounting from other authors, as you can see there, which are available on Amazon. And there's information on Wikipedia as well. And as I said, the Lean Accounting Supergroup and the BMA website. So thank you very much for your time. For more information, as I say, visit the BMA website where you will find more webinars, videos, articles, and so on. And also have a look at the Lean Accounting Supergroup, which is a sort of community of people implementing lean accounting, raising questions, etc. Thank you very much for your time. I hope that was helpful. It's been a pleasure speaking to you. My name is Ross Maynard. I'm a fellow of the Chartered Institute of Management Accountants here in the UK. Thank you. Goodbye.